Hello and welcome to Accounting with Mr. H. In this video we're going to look at how to prepare an income statement for a limited company. Please subscribe to the channel. Thank you if you already have done. Like, share, comment on the videos. Let me know what you find useful and what you'd like to see in future videos. Let's get on with the question then. So what have we got here? Limco Limited has prepared the following draft income statement for the year ended 30th of April 2024. And then underneath, I'm just going to skim through the information just to get a feel for the question. Item 1, included in the revenue of goods sent on a sale or return basis. Item 2, no adjustment has been made to the provision for doubtful debts. 3, included in selling and distribution expenses is 1680 for a 3-month campaign which started in March. 4, 1st of May 23, the company had issued 120,000 debentures. 5, estimated taxation payable. And I'm being asked then to prepare a revised income statement for the year ended 30th of April 2024. So I need to take into account then the 5 items of additional information that are underneath the draft income statement. So you'll see I've got it set up ready. I've got my title, who, Limco Limited, what, an income statement, when, for the year ended 30th of April 2024. And off we go then. So the first figure, as always, is going to be revenue. And I'm just going to go back to point 1 because I remember it said something about a sale or return basis. So point 1, included in the revenue is £17,595 of goods sent on a sale or return basis to a customer. The goods were returned unsold on the 1st of May 2024. Limco Limited adds a 70% markup to these goods. So the company has included this 17,595 in the revenue. Well, they can't do that because these goods were sold or sent to the customer on a sale or return basis. And as it happened, they ended up being returned unsold. Until it's actually known that the sale has been completed, we cannot include things in revenue. It goes against the realisation concept. So simply then, I'm just going to take that 17,595 out, which is going to bring the revenue down. There we go to 910,435. Next item then, the cost of sales. Now, quite often in limited company financial statements, we don't always see the breakdown of opening inventory, purchases, closing inventory like we might do in a sole trader income statement. We've just been given the cost of sales figure. But I've got to consider the fact that these goods that have been sent on a sale or return basis will have had an effect on the cost of sales figure. Because the company treated these goods as having been sold, they included them in the revenue, as we know, but we've dealt with that. But because they treated it as if they had been sold, that means they won't have included them in their closing inventory because they thought, or they treated them as having been sold. So their closing inventory at the moment is understated. So I need to increase the value of their closing inventory. So let me put a narrative, cost of sales, but I'm going to need to do a little bit of working here. So I need to work out how much needs to be added onto the closing inventory. Now, inventory is always valued at the lower of either its cost or its net realisable value. Well, there's no mention here to suggest we need to worry about net realisable value, but it tells us in that last sentence, Limco Limited adds a 70% markup to these goods. So we were given the selling price, 17,595, but that will include the markup. So whatever the cost was, they added 70% and they got 17,595. So to work out the cost then, you can see my working there. So I'm dividing the 17,595 by 170% and then multiply by 100 tells me that the cost of these goods is 10,350. If you prefer to work with decimals, you could just divide by 1.7. So 10,350. But remember, I've just been given the cost of sales figure, so this just needs a little bit of thinking. So I'm about to increase their closing inventory because we're now saying that they own these goods. So if you think about the formula for the cost of sales in simple terms is opening inventory, add purchases, less closing inventory. Well, we're about to take away more closing inventory because we're about to increase the value of the closing inventory. So if I take away more closing inventory, what that's going to do is going to reduce the cost of sales. So I'm going to take their cost of sales figure, 511,400, and I'm going to take away then this 10,350, which we're adding onto the closing inventory. And that's going to give me a new cost of sales figure, which I'm going to write in there, £501,050. Then I can take that away from the revenue to get the gross profit. There we go, £409,385. Now I come on to the next section then, the profit and loss section. And in the draft income statement, it's got other income, £11,450. Just looking at the additional information underneath, we've dealt with item 1. Item 2 then, it is about these doubtful debts. It says no adjustment has been made to the provision for doubtful debts. And the thing with doubtful debts is always to remember that when the provision changes, depending whether it needs to increase or decrease will depend whether we need to treat it as an income or an expense. So I'm going to do the working out here before I go any further. I'm going to put a narrative ready, other income, and let's have a look then. So the provision for doubtful debts at the 1st of May 2023, so that was the beginning of their financial year, was £4,300. Trade receivables at the 30th of April 2024, so the end of this year, amounted to 164,000. It is the company's policy to maintain the provision for doubtful debts at 2.5% of the trade receivables. So I'm going to find 2.5% then. Let's find what the provision needs to be at the end of the year. So £164,000 of trade receivables, 2.5% of that figure is 4,100. But we've been told the provision is currently at the start of the year 4,300. So they need to decrease their provision by £200. So that's a good thing. There's, if you like, these doubtful debts, they're being prudent. Remember, this goes with the prudence concept. So they're being prudent by considering the fact that not all of the trade receivables might pay them, but the provision is falling. So decrease in provision for doubtful debts gets added on as other income under the gross profit. So their other income was 11,450. So I'm going to add on to that other income another 200 then for the decrease in provision for doubtful debts, which is going to give me £11,650 of other income. You could do it as a separate row. I haven't got much space on this slide. In an exam, I might be inclined to do it as a separate row, just to make it clear, and also then it will be easier for the examiner to see your workings along with the figure. So I could have left the other income at 11,450 and then had another row which said decrease in provision for doubtful debts, £200. The important thing though is that we are adding this 200 along with the 11,450 onto the gross profit, which gets me to a figure of £421,035. All right, let's continue. I've just scrolled mine up a bit so it can fit on the slide. So there's the 421,035 where we've just got to. And now I'm coming on to the expenses. So the first expense is the selling and distribution expenses. Limited companies often group together their expenses, a bit like we talked about before. A sole trader, you will often see individual expenses, advertising, rent, insurance, but limited companies often group them together. So all of their selling and distribution expenses, the draft income statement says were 49,700, but I'm just going to item 3 over on the left, and it says included in selling and distribution expenses is £1,680 for a 3-month promotional campaign which started on the 1st of March 2024. So they've paid for some sort of promotional campaign, maybe some advertising, which is going to last for 3 months. Well, that's going to run then through March, April and May, but we're only doing the accounts up until the end of April. So a third of that amount doesn't relate to this year. In effect, it's a prepayment. They prepaid a promotional for a promotional campaign for the first month of their next financial year, for May 2024. I've got to assume that the promotional campaign, that the cost of it is even over the 3 months. It doesn't tell me otherwise. So my working then, I'm going to take the 1,680 and simply divide by 3. So the monthly cost is £560. And we know then we need to keep 2 months in, but this third month, this month of May, doesn't want to be in these accounts. It's a prepayment. So I'm going to take their figure of 49,700 and take out the 560, which gets me to 49,140 for selling and distribution expenses. Remember, adjustments like this comply with the accruals concept, because we are matching the income or expenditure, as it is in this case, to the year that we are reporting on. Next thing is the administration expenses, and I'm just going to jump down to item 5 because I can see administration expenses has been written there. Item 5 says the estimated taxation payable for the year of £17,900 has been included in administration expenses. So they're testing here that I understand where tax is supposed to go in a limited company income statement, and it's definitely not supposed to go here. It doesn't go as an expense up at the top in the expenses section. So all I'm going to do simply is remove it. So they had administration expenses 62,380, and I'm just going to take out that tax for now, 17,900. So the administration expenses 44,480. Next is the depreciation. In this question, it doesn't say anything about depreciation underneath, so it must just be right then as it is. So I'm just going to put that straight in. Depreciation 38,000. Then I'm going to total up the expenses, which are now £131,620. Take that away from the 421,035 to find the corrected profit from operations, which is now £289,415. And this is again where a limited company income statement is different to that of a sole trader. In a limited company income statement, the final bit of the income statement breaks up different types of profit and also considers any interest and any tax. And it always takes 5 rows. So row 1 is profit from operations, which we've just worked out. The next row is often called finance costs. In other words, the cost of any finance that the company has borrowed. Interest is the main cost of finance. So if the company has any debentures, for example, or even a loan, then they will have been paying or need to pay interest on that, and so that is known as a finance cost. If you put debenture interest as the narrative, it wouldn't be the end of the world, but finance costs or debenture interest, that will be fine. So let's work out then the debenture interest. So if I look at point number 4, it tells me at the 1st of May 2023, the company had issued 120,000 7% debentures. So they'd already issued those at the start of this financial year. The company issued a further £40,000 worth of 6% debentures on the 1st of October 2023. No debentures were redeemed during the year. So redeemed, it basically means paid back, paid off. So they had 120,000 at the start, which they've still got at the end, and they issued a further 40,000 during the year. So I need to calculate the total interest on these debentures that relates to this year. So I'm going to do it in 2 stages. I'm going to start with £120,000 worth of 7% debentures. The percentage is the interest rate. So 120,000, 7% of that is £8,400. They've had those debentures all year for all 12 months of the year. So that figure then is fine as it is, 8,400. The other debentures, £40,000, 6%. So 6% of 40,000 is 2,400. But I've just got to watch the dates because they only issued these on the 1st of October 23. So they haven't had these debentures for the entire financial year. so they're not going to pay interest on the period where they hadn't issued them. So let's just count the months. So if they issued them on the 1st of October, so they've had them then for the whole of October, November, December, January, February, March, April, 7 months of the year. So I'm going to take that 2,400, which is the yearly interest, divide by 12 to get the monthly interest, and then multiply by 7 because they've had them for 7 months. So the interest that relates to these debentures is £1,400. And then you'll see I've highlighted these two figures. So that's the 8,400 for the debentures they've had all year, and then 1,400 of interest for the debentures they've had for part of the year. So if I add those two highlighted figures together, it gives me £9,800, which is the debenture interest then that relates to this year. And I'm going to put that then in the income statement. And there we go. So what then happens is we take that away from the profit from operations, and that gives me profit for the year before tax, which is £279,615. Nearly there then. As I said a few minutes back, in a limited company income statement, try to remember that the end of it goes in 5, there are always 5 rows. So profit from operations, done. Then take away any finance costs, basically debenture interest or loan interest. That gets you to the profit for the year before tax. And then finally, we need to take off any taxation that is due on this year's profits. And in this question, if I go back to point 5, we will remember that they had put the taxation in the wrong place. So the estimated taxation payable for the year of 17,900 had gone in admin expenses. Well, we've dealt with it up in the administration expenses, and where they should have put it is here. So now I'm just going to put that back in. So taxation 17,900. Then I'm going to take that away from the profit for the year before tax, and that gives me the final figure then. Profit for the year after tax is £261,715. So 5 key rows at the end: profit from operations, less finance costs such as debenture interest, equals profit for the year before tax, less tax, equals profit for the year after tax. In mine, I haven't put the finance costs and the tax in brackets, but you absolutely can do, if that's going to help remind you to take them away. I hope that's been helpful then. Please do subscribe to the channel, like, share, comment, let me know what you'd like to see in future videos.